Okay, let's just jump right in. What you're looking at here is pretty much the biggest battle happening in the global market today. On one side, you've got this incredible tidal wave of AI productivity, a real innovation boom that's pulling everything up. But on the other side, you've got the financial system, which is being drained of cash, creating this massive liquidity drought. This tug of war, well, it's the defining story for the market right now, and we're going to break down exactly what it all means.
And that brings us to the core theme of this entire analysis, what we're calling the Janus market. Named after the two-faced Roman god, it perfectly describes a market that's looking in two completely opposite directions at the very same time. On the surface, what we see is this brilliant AI-fueled renaissance. But if you look deeper, underneath it all, you start to see these deep systemic cracks forming.
So you have to ask, how can both of these realities exist at once? Well, the answer is what institutional traders are calling the AI shield. As you can see here, the incredible power of the AI narrative is basically acting like a shield, holding up a world that's being weighed down by some really serious problems. Stubborn inflation, slowing growth, massive debt, and a critical liquidity stress that's being caused by the Treasury. For right now, that shield is holding.
So let's start with the bull case, right? The force that's actually holding up that shield, the AI growth engine. And look, this isn't just some trend. We're talking about a full-blown technological renaissance. And the numbers, they are absolutely staggering. Just look at that number, $68.1 billion. You know what that is? That was Nvidia's revenue for a single quarter. It didn't just beat expectations, it completely obliterated them and single-handedly rewrote the entire narrative for the market.
Now, what's really interesting here is the story behind that number. That incredible 73% year-over-year growth isn't just part of some normal cyclical upswing. No, this signals a massive structural shift in how companies are spending their money. They are in an absolute arms race to build out their AI factories, and that spending is showing up right here in these results.
And all of this has created a brand new investment theme that the pros are calling the halo trade. It stands for heavy assets, low obsolescence. And the crucial point here is that capital is fleeing from intangible things like software, which is now seen as really vulnerable to AI disruption, and it's rushing into the tangible, physical stuff that's needed to power this whole revolution. We're talking power grids, advanced cooling systems, and the data centers themselves.
Now, if this whole thing feels a little familiar, it should. This chart here compares the current AI-driven rally to the 1995 internet boom. And, the trajectory is strikingly similar. But, and this is a huge but, there's one critical difference: the fiscal environment. See, back then, the government and the Fed were helping things along. Today, we have a major fiscal drag and a Fed that's still trying to fight inflation. That's a unique challenge that just didn't exist back in the 90s.
And that brings us perfectly to the other face of the Janus market. We've seen the brilliant renaissance. Now let's pivot and look at the cracks in the foundation, the really serious risks that are hiding in plain sight, just under that shiny surface.
So we have to ask the obvious question, right? Is this spectacular AI-powered growth the whole story? As you probably have guessed by now, the answer is a resounding no. Let's start peeling back the layers.
The first major warning sign is coming from what a lot of people are calling the canary in the coal mine, the private credit market. This chart is absolutely crucial. See that bottom line? That's stable, investment-grade debt. But that top red line, that's the interest rate spread for private credit and high-yield debt, and it is skyrocketing. That is a classic, textbook signal that default risk is rising, and it's rising fast.
And listen, this warning is coming from the very top. JP Morgan's CEO, Jamie Dimon, he compared the problems in private credit to cockroaches before the 2008 crisis. When a $1.8 trillion market that basically operates in the shadows starts to crack, well, that's a systemic risk you just cannot ignore. Okay, the second major risk is a bit more technical, but it's just as dangerous. Think about it like this. The U.S. Treasury is basically the government's main checking account. And to fill it back up, it's now pulling $850 billion directly out of commercial bank reserves. This is what's called a hidden tightening. It's a massive liquidity drain that's starving the financial system of cash. And this is dangerous because it could trigger a market seizure, kind of like what we saw back in the 2019 repo crisis.
And the warning signs really don't stop there. Everywhere you look, the foundation is just weaker than the headlines suggest. We're seeing what's being called an AI phobia hit older software companies. We're seeing the consumers start to buckle at major retailers. And maybe most alarmingly, subprime auto loan delinquencies just hit an all-time high. Not good.
So you're faced with this two-faced Janus market. How are the professionals, the big institutional investors, actually playing this? Let's take a look at their playbook for trying to navigate this incredibly complex environment.
And honestly, the strategy couldn't be clearer. As you can see right here, it's all about that halo trade we talked about. Institutions are going overweight on tech hardware, on utilities for power generation, and on industrials, all the physical things AI needs. And at the same time, they're aggressively underweighting the vulnerable sectors, tech software, real estate, and the financials that are exposed to that shaky private credit market.
This slide pretty much lays out the two main paths that institutions see from here. Scenario A is the soft landing, where inflation behaves and AI keeps growing. The play there is to lean into tech and healthcare. But then you have Scenario B, a stagflationary shock. The triggers for that would be oil shooting over $90 a barrel or a sudden spike in the repo rate. And the action there is purely defensive. Hold a lot of cash, hedge with energy, and have a very clear stop loss in place. But there's one more risk, a potential black swan that the market seems to be totally ignoring right now. For years, investors have borrowed Japanese yen at basically zero interest to invest in higher-yielding U.S. assets. Now, if the Bank of Japan suddenly decides to hike rates, that entire trade could unwind violently, pulling a tidal wave of capital out of U.S. markets and creating a kind of liquidity black hole. So where does all this leave us? With this intense tug-of-war between the AI boom and all this systemic risk, let's get to the final verdict on how to think about today's Janus market. The final verdict is tactically bullish. Now, what does that actually mean? It means that the AI growth engine is powerful enough, at least for now, to overcome those liquidity headwinds. But the crucial point is this. You have to ignore the daily news cycle and focus intensely on just two things: liquidity and earnings. At the end of the day, those are the only numbers that truly matter. And this leads us to what is maybe the most important takeaway from this entire explainer. That simple strategy that has worked for a decade, just passively buying the dip every time the market wobbles, that era is over. In this Janus market, survival and success are going to depend on actively identifying those companies with real, irreplaceable physical moats, those halo assets we keep talking about. So, if you're going to block out all the noise and just focus, what is the single most important piece of data you should be watching starting tomorrow?
It's this, the Treasury General Account, or TGA, balance. I know, it's not a headline number, but it's the key. It tells you, in real time, whether that hidden tightening we talked about is actively draining the lifeblood of liquidity from the system. If this number starts moving the wrong way, it could be the very first signal of an imminent market shock.
And that leaves us with this one final thought. A kind of harsh lesson from financial history that perfectly captures today's market. Where the intangible illusion of software collapses, only the heaviest iron, copper, and power will survive. The dazzling innovation of AI is absolutely real, but it carries in its shadow the bankruptcy of old business models. The key is to know which side of that line you're standing on.